Y'all ready? Here we go. In my fantasy, every co-op started over dinner. Maybe folks are sitting around a table late in the evening, wine glasses half full. The conversation flowed this way and that until someone said, you know what we need to do? Open a food co-op. That was the moment of birth for the vision of the co-op. Something in that conversation, some need, inspired the idea that a particular kind of co-op would fill an empty niche in the community. As people continue the conversation, the vision grew. Now imagine this is true of your co-op too. And now everything that you imagine your co-op to be is part of the vision. Maybe it's still a bit hazy, or maybe the vision is crystal clear. It might include the kinds of products that the co-op will sell, the customers it will serve, its location and size, the wages it will pay. That vision is the heart of your narrative, the story that you're telling over and over. It's told on your website, on Instagram and Facebook, in writing, and person to person. That vision is going to lead people and agencies and lenders to join your efforts as members and funders. And if you're successful, you'll cut the ribbon and celebrate. If you're really successful, in 5 years, it's going to be a big celebration because then you know that the co-op is actually sustainable. Greetings wherever you are. Up and coming 2020 was the last normal outing for me, and I'm sure for most of the attendees, just before we began sheltering at home. I'm glad to be back with up and coming 2021. The Zoom has been an amazing tool for connecting with people in this time of the pandemic, and I'm using it to record this session. But I am very much looking forward to seeing you all in person at Up and Coming 2022. I'm Don Moffitt, and I've been involved in the retail food business since 1981. I took a short-term job with Whole Foods Market. At the time, there was just one. It was just a funky little store, and I found a home there that was new and different. My short-term job lasted 18 years. I have a degree in architecture, so when Whole Foods started expanding, it fell to me to oversee store development. I was eventually responsible for real estate, design, construction, and equipment. Over the years, I ran a store, I ran a region. And after I left the company, I went back to college and got my MBA. I served as the project manager for Durham Co-op Market, which has been open 6 years. During the time that I was working on the co-op, I met Bill Gessner and started working closely with him. Those of you who knew Bill knows that he was all things co-op. And working with him was a terrific education in financial feasibility for co-op grocery stores. These are some of my clients. These are more of them. I work with a lot of different people. Some are big, some are small, some are open, and some, like yours, I imagine, are in vision and in process. Now, I hope that this session is valuable to you on its own merits, but I'm also laying the groundwork in this session for an interactive session that I'll be leading right after the break. In this session, I'm going to talk about financial statements, the pro forma, and how your vision for the co-op impacts outcomes. Following the break, we'll really dig in and begin to experiment with adaptations and modifications to see how you can increase the financial feasibility of your co-op. So if you're looking for a quick list of items that connect your vision to impacts on co-op performance, you should know this is going to be more involved. I'm aiming towards co-ops in early stage 2, as we'll talk about in a minute. This is a basic course, a building block in your financial knowledge. In this session, I'm planning to talk about the 4 areas of feasibility, the 3 key financial statements, calculating cash flow, financial sustainability, the basics of the pro forma model, an intersection of our vision and outcomes, and the big levers in changing those outcomes. Now here we have the 3 main stages of co-op development, along with some of the sub-stages and key steps in the process. You're probably familiar with the outlines of this model for co-op development. Stage 1, shown in beige on the left, is the organizing stage, where you begin envisioning the co-op, you incorporate, figure out how you all are going to work together, and start building support in your community. Stage 2, in yellow and orange, is the feasibility and planning stage, when you start looking for locations and really exploring how your vision will work with the trade area. This stage ends when you have control of a site that you think will work. You should have a contingency clause that allows you to drop the site if you can't raise the funds required, or for some other reason it turns out it doesn't work. That's why at the end of this stage, there's a dashed line that signifies your ability to go back to stage 2, the feasibility and planning. Now, raising the funds, permitting, design, all of that is in the first part of stage 3. Stage 3 is in green. That part ends when you go hard on a lease, drop the contingencies, and commit all of the resources of the co-op to opening the store. That's signified by the hard red line at the end of the stage 3A. That's when you make the go, no-go decision, because once you cross there, there's no going back. So you're here today. So I'm going to guess that you're in this stage and that you're exploring all 4 areas of feasibility. The first is financial, which is demonstrated primarily through the pro forma. The second is the trade area or the market, demonstrated through the market study. The third is specific sites, which is demonstrated with a list of key required attributes that you've put together, and a preliminary floor plan showing how a co-op, a grocery store, will work in the space. And then there's your own organizational readiness to move forward in all 4 of the cornerstones of the project: vision, talent or the people involved, capital or finance, and systems. This stage, early stage 2, is a great time to consider the vision for the co-op and the financial impacts of that vision. Today is all about the interplay of vision and financial sustainability. I'll come back to vision in a bit, but right now, let's look at more closely at the financial part of the puzzle. When I talk about financial statements, I'm talking about the 3 main statements: the income statement, the balance sheet, and the cash flow statement. We're going to talk about them a lot. The income statement shows all of the operating activities during a period of time. For us, that's going to be a year. The balance sheet shows the financial condition of the co-op at a point in time, right? So we're going to look, it's like a picture. For us, it's going to be at the end of each year. The cash flow statement combines the income statement and changes in the balance sheet to calculate the inflows and outflows of cash and to predict how much cash there will be. It covers the entire period of time, like the income statement does, and it'll tell us what to expect at the end of the year. So on the income statement, there's a lot of activity on a daily basis that impacts our cash. We pay our vendors for the products we received. Customers check out at the cash register, paychecks are distributed, store supplies are purchased, and so on. Many of these activities are captured in the income statement, which most of us are at least passingly familiar with. An income statement or profit and loss shows the amount of activity for a given period of time, right? We're using years. So first thing that we look at is revenues, or in our case, sales. And then we subtract the cost of the goods that we sold for those sales. And when we do, what we have left is the gross profit. The next thing we look at is personnel expense, because that's our next largest expense after the cost of goods sold. And then we're going to look at all the other operating expenses. When we subtract those from gross profit, what we have left is the net operating income. So we're going to talk about that more, but right now we're going to talk a little bit about the balance sheet, right? I'm going to build and build and build. So the balance sheet, most of us are pretty familiar with the income statement. The balance sheet's a little harder to understand. The concept, though, is simple. It's like a photograph of the financial health of the co-op at any time. In the pro forma, we look at the balance sheet, right? 1 year, as we just talked about, then after 2 years, and so forth. It's got 3 parts. The first part is the assets, or what the co-op owns. The second part are the liabilities, or what the co-op owes on the assets that it owns. And the third part is the equity, which is what the co-op is worth. And the assets are equal to, they balance the total of liabilities and equity. Now, assets are divided into short-term and long-term items. Short-term items are called current assets. The word current in the balance sheet means 12 months or less. And in this case, these are assets that can be converted to cash within a year. So an obvious one is the cash. That's an easy. The next one is inventory, right? Because you can generally sell your inventory within the year. Long-term assets, or sometimes called fixed assets, and they include things like land, the building, the interior improvements, equipment. These are the really big assets. The liabilities are also divided into short-term or current liabilities and long-term liabilities. Current liabilities have to be paid within 12 months. The biggest one is usually accounts payable, which is what we owe our vendors for products that we've received. Our second biggest liability, or current liability, is typically our payroll. It's what we owe our staff for time it's been worked, but for which they haven't been paid yet. Of course, our big long-term liabilities are our debts. Now, equity, whoops, let me go back. Equity includes the money that our members gave us to become members, usually to purchase a common share of the co-op. It also includes the value of the preferred shares that we've sold. Profits and losses are also included in equity. Here's why, and I'm probably going to talk about this a little bit more later. If we operate the co-op for a year and we make a $100,000 profit, we've increased the value of the co-op by that much. Remember, equity is what the co-op is worth. $100,000 came in that didn't have to be paid to vendors or the staff or the landlord or anyone else. So we add it to equity. And then next year, we move it from this current profit or loss, and we put it in accumulated profit or loss, of what we call retained earnings. If we pay dividends on stock, whether it's our common stock for membership or it's preferred shares, we pay it out of our profits. So we also record that in equity. Of the 3 financial statements, this one is the most important. This is where the magic happens. Some of the co-op's activities are captured in the income statement, right? But some of the activities, like when someone comes in and joins the co-op and writes a check and that goes into an equity, it's not income, not recorded on the income statement. That's on the balance sheet. So if we want to predict what will happen with cash, we combine the income statement with the changes in the balance sheet to see what's going on. Now, the cash flow statements that I produce have 4 sections. First is cash flow due to operations. It includes the change in cash due to the daily operating activities of the co-op, which shows up on the income statement, the profit and loss statement, as the profit or loss for the year. But it's not quite so simple. Some items on the income statement don't impact cash, like depreciation. It's not a common concept, and I can explain it, so I'm going to digress for a moment. When a co-op buys a refrigerated case for, in my example, $7,000, they trade an asset, which is cash, for another one, which is the refrigerated case. So in theory, they could turn around and sell the case for $7,000. There's no change to the financial health of the co-op. It's not an expense, and it's not recorded on the income statement. However, that case is generally considered to have a useful life of 7 years. So after a year, $1,000 in the value of the case has disappeared because of wear and tear. It's like having a used car. That's how much it has depreciated, right? $7,000, 7 years, $1,000 has disappeared. We record that as an operating expense. Remember, though, that there's no change in cash attached to that expense. The cash left the building back when the case was purchased originally. So the depreciation expense lowers our net income, doesn't impact cash, so we add it back in the first section. I'm going to show you this in more detail later. We make some fairly minor adjustments for changes in the balance sheet, like inventory and accounts payable, because they don't show up on the income statement, but they do impact cash. Now, the second section is cash flow due to investments in our assets. Typically, this is going to be a capitalized purchase of equipment or repairs to the building. Remember the $7,000 refrigerated case we were just talking about? When we traded the cash for it, the value of our assets went up, right? Because we got the value of our equipment asset went up because we bought a new piece of equipment. So the $7,000 in cash we traded for equipment goes up. And if we want to know how much we actually used to buy equipment during the year, we simply subtract off what we had at the end of last year from what we have at the end of the current year. And the difference is how much cash was used to increase the value of our equipment. It's confusing, but we'll talk about it more. Okay, the third section, because I'm just trying to lay groundwork here. The third section is cash flow due to changes in equity, right? So this is where when somebody walks in and joins the co-op, they write a check, then that goes into the equity account and that goes into the cash flow statement. And it comes from looking at the balance sheet. What's the difference in this year versus last year? So when we add these up, what we get is what we call the cash flow before debt service. And that's the fourth section, debt service. Debt has two major components. We pay interest to our lenders, and we also have to make payments on the principal of the loans. But we could also be borrowing more money. And in that case, instead of being like if we make a payment on a principal of a loan, it's going to be a negative cash flow. But if we borrow more money, like co-ops got PPP loans this last year, well, that increased the cash, and that shows up as a positive number in this debt service line. So we could actually call this cash flow due to changes in debt. When we add that in to the previous line, then we find out what our total cash flow is for the year. And we should be able to estimate what cash is at the end of last year. So we add the cash flow to that to get an estimate of what cash will be at the end of the current year. So all of this, the financial statements and understanding how they work, more coming up, but understanding how they work is the beginning of understanding how retail grocery works financially. This is groundwork, so don't worry if it's still confusing at this point. Okay, let's see if this works. Yeah, so far I've talked about the 4 areas of feasibility with a focus on finance. I've talked about the 3 key financial statements at some length, and I talked quite a bit about how cash flow is calculated. Now, why do I think this is so important? Remember our starting place about how your vision developed and became part of your narrative? Well, there's more to the story, of course. Your vision drives the narrative, which attracts support. And the support from new members and grantors and lenders drives results. But your vision also drives results, which become part of the vision and the narrative. It goes around and around. If the results are strong enough, you're in great shape. But if they're not, the vision may need to adapt. Everything involved in opening your cooperatively owned grocery store impacts the sustainability of it. How big it is will impact the costs of building it and equipping it, and therefore how much you might need to borrow. Choices for equipment likewise impact those costs. Your vision for the products sold, the prices charged, the wages paid, all affect operating revenues and expenses, and ultimately the financial outcomes. Now, my job in creating a pro forma is to take your vision and imagine it unfolding and describing it in the pro forma. The vision leads to the assumptions about how much it will cost to develop the store. The vision leads to assumptions about how much it will cost to operate the store, how much funds you'll need to open it, what the debt will be like, and what the operating results are going to turn out to be. If you're going to modify your vision to strengthen results, you need to understand how the results are determined. That's why we're spending so much time on the financial statements. And it helps move you towards the goal of a co-op that operates according to your vision and is sustainable financially. Now, when I develop a pro forma for clients, we look at a host of metrics. This is the primary list. It includes metrics like net income, and EBITDA, debt to equity ratio, debt service coverage ratio. These all indicate to potential lenders whether the co-op is going to be able to repay debt. However, before any of that, if the pro forma indicates the co-op is going to run out of cash, none of the other metrics matter. Cash, then, is the only metric we're going to consider today, the change in cash and the resulting amount of cash on hand. So to understand more about your vision and results and their intersection, let's turn to the pro forma and see how it works. So keep in mind that the pro forma looks at two time periods that are interrelated. First is the time from the beginning of the co-op, when you first opened a bank account, to the opening day of the store. The second starts on opening day and covers the first 10 years of operations. What happens in the first phase, your vision, the associated expenses, the sources of funding, they all lead to the amount of debt required, which in turn leads to an estimate of the annual debt service. Your vision influences the sales and the expenses during operations, and combined with debt service tells us what to expect regarding cash flow. It might look like this. Notice where zero is on the left. That's when the co-op would run out of cash. In this scenario, it doesn't go below zero. In fact, the co-op always has a cushion of $200,000 or more, which is fairly critical in case of unforeseen events like a competitor opening up. Or cash flow might look like this. Although in this scenario, cash is pretty strong at the end of 10 years, the co-op runs out of cash near the beginning of year 2. In this scenario, the co-op will go bankrupt. Or even worse, it might look like this. Every year, the deficit continues to grow. So vision impacts results, impacts vision. Now we're going to go a little deeper into the pro forma itself. And after the break, we'll look at the vision, the pro forma, and the results together. We'll start here. So this is the first phase of development, right? This is from opening day until the day the store itself opens. We estimate the cost to develop the co-op and the store. Get my cursor. There we go. Okay. These are the uses of the funds right here that you need to open a store, the costs. The FCI has a great worksheet on its website. It's called the Sources and Uses Budget Template. If sources and uses are unfamiliar to you, make a note to go to fci.coop and download the Sources and Uses Budget Template along with the user's guide. So what we're looking at is uses of funds table in today's sample pro forma. It's interactive with other inputs. For example, if the size of the store changes, which is here, then the cost to develop it will change as well, as long with the cost to design it, equip it, the inventory, all those things will change. They're all interactive. Now, I have two shades of blue. Blue on my pro formas generally indicate a place for inputs, but the light blue means that I've actually moved that input to another worksheet so that when we do our workshop later, it's a little bit easier to experiment. This co-op wants to build a store that's 8,000 square feet in size with 5,200 square feet in the sales area. Now that's right up here. They're planning the lease, so there's no cost to acquire a site. There's no cost for a shell, building, or parking lot. There is, of course, significant amount of money for interior improvements and for equipment. And there's a lot of other costs as well. And you can see that the total cost is just under $3.6 million. Once we have an idea of what the store cost to develop, the co-op needs to identify where those funds are coming from. So, sorry. Let's see, here we go. So down below, I have the sources of funds table. So I have a assumption that there's going to be 1,200 people that join the co-op by the time it opens. They'll pay $150 each. That's $180,000 in startup capital. Now, this board is going to be aggressive, energetic. They're going to go out and sell the narrative and raise $1.5 million from their members in additional capital. In my example here, it's going to be in member loans, not preferred shares. Then they're going to get $25,000 in donations, but they're also planning to raise $1.5 million in grants. That's terrific. The TIF and this is tax increment financing funds and new market tax credits. So these are sometimes programs that are available. I'm assuming no money here for those. Then there's the landlord allowance. Sometimes you can get a landlord to participate by contributing to a tenant improvement allowance. I'm assuming nothing. The vendors, we think, will come in for a small amount of the inventory that's going to go into the store. And then there's two loans that this co-op is sourcing, one from an economic development agency and one from a foundation for what's called program-related investments. These will be low-cost loans. Finally, the primary loan automatically calculates to be whatever is left over. Like if the cost of the co-op is 3.6 million and all of the other sources are 2.6 million, this would be $1 million. But because of the grants and the member loans, they actually are raising $10,000 more than the cost to develop the project. So the next worksheet, which is debt, here is the bridge between the first phase, right, which is until opening day, and the second phase, which is the 10 years following opening day. So all those costs that we talked about lead to all the sources, two of which were loans. Well, actually three, because there's the member loans, the program-related investment loan, and the economic development agency loan. So all of those will require debt payments over the course of the 10 years of the pro forma. So on this page, we make that leap. We start by coming up with assumptions for interest rates and amortization periods, which is the time that you have to pay the loan back. You can see the economic development loan is low interest and has to be paid back within 7 years. The program-related loan is a little higher interest, but still pretty good with an 8-year payback. And then when you get to the member loans, this is where your vision really comes in again, right? Because you're going to go out and get people to invest. Well, how much interest are you going to pay? Will it accrue and be added to the principal each year, or will it get paid out in cash annually? When will the principal payments start? How much will they be? How long will they take to get paid? All that goes into the debt schedule. So if you look, this one, I'm assuming a 4% interest. It's going to be paid annually. And you can see here in year 7, there's a principal payment. That's when we start principal payments of $100,000. That's what I'm assuming initially with this pro forma. Okay, so there's some more assumptions that we want to look at, right? This is all the debt. So the full pro forma will generally have quite a few assumptions on the operating page. I've got 5 today. The first is sales. And typically, like I don't estimate sales. That's done by a professional, a market analyst like Debbie Swasuna, who's with Colluminate. And Debbie would do a market study and come back and say, well, based on a 6,000 square foot store, or whatever size she's thinking, she would also say it's based on a mix of products, like 100% natural and organic, 100% hybrid, conventional products, or a hybrid, which would have a mixture of conventional and natural and organic. All of that goes into the assumptions that she has for coming up with her sales figures. So I've made up sales figures as though I got them out of a market study. That would be the first 4 years. They're based on 6,000 square feet, but this particular store was going to be 5,200. Well, a smaller store won't do the same amount of sales as a bigger store. So they get adjusted in the pro forma for the different size. And then I do a second adjustment, because what Debbie assumes is that the way her market study works is that it's based on the idea that the store would be have fully mature operating systems from the beginning. But that's not going to happen. The new co-op is going to take time to build systems for things like purchasing, pricing, merchandising, marketing, labor scheduling, and all those are going to impact sales, gross margins, and personal expense over the first 2 or 3 years. So in this case, I'm adjusting year 1 sales down 18% to try to better reflect what the actual results will be. The second year, I'm adjusting down 12%. The third year, 6%. And then by the 4th year, I'm saying this co-op will be running on all cylinders and it will make the sales that Debbie is forecasting for it. Let's see. Now, the 2 biggest levers for changing outcomes in the income statement are gross margin and personnel expense. So while the store is in the concept stage, these levers belong to the board of directors. After the general manager is hired, they belong to her. So gross margin, which you should remember is what we have left after we pay for the products we've sold, might vary depending on the product mix, right? So this market study was based on a hybrid of clean, conventional, and natural and organic. Now, a co-op which focuses on natural and organic might get a gross margin of 38 or 39%. An independent grocery store that focuses on conventional might get a 30% margin because the competition is more intense, right? It's dollar stores, it's Walmart, it's conventional grocery stores. And so they're pricing lower and they're getting a lower gross margin. The 9% of sales that I was just talking about is a huge number. So they're really low. Now, the same thing happens with personnel. For the co-ops in the natural and organic world, they're making a higher gross margin. So they spend more on personnel expense. They might spend 24.5 or 25% of sales. That conventional grocery store I was telling you about, the one that's getting maybe a 30 gross margin, well, in order for them to be able to pay all their other expenses, they have to keep personnel more like 16% of sales. They do that by having fewer full-time people, by paying a lower base wage, and by having fewer benefits. But there's almost no room to give. So depending on the margin, you're going to have an impact on personnel expense. If we look at it from the other way around, if we start with, well, how many people will it take and what kind of wages will they get paid, then the personnel expense is definitely going to be a factor of the vision that you have. So this is a real place where vision and financial reality intersect, and we have to look closely at it. Now, I've added in a couple other expenses. One is rent, and what I would call the additional rent or triple net. These in a commercial lease, typical lease, the tenant pays the rent, but they also pay the landlord's cost of operating the building. Those are three items. It's the real estate taxes, it's the insurance on the building and the property, and it's the common area maintenance. Common area maintenance usually includes things like parking lot cleaning, roof repairs, landscaping, and the tenant pays a share that's proportionate, the size of their space to the entire shopping center. So that's called triple net because there's three, or additional rent. So I've got $4 in for that. And then finally, one other thing that I'm adding, because it can be considerable, is a table for member equity. So this is estimating how many people will walk into the store in the first year or the second year or the third year and get excited and join the co-op. So they'll write a check, leave that behind. And that's not on the income statement, if you remember. It's actually deposited as a change in equity. So cash goes up and equity goes up on the balance sheet. So on sources and uses, we considered the vision for the co-op when we were talking about the size of the store. And it's also inherent in, so that runs all the way through the cost to build it and equip it and so forth. On this page, we considered the vision for the co-op when we estimated the gross margin and the personnel expense. So to this point, we've looked at the co-op's vision for the customers it's going to serve, the size, the appearance, the location, the products, the wages it's going to pay. The pro forma is impacted by changes to the cost to develop it, and the changes in sales, and the various ongoing operating expenses. But our goal is a financially sustainable co-op operating in accordance with that vision. So how do we define sustainability? So remember that I said we're focusing totally on cash. That's what we're going to do today. And I want this co-op to have at least $200,000 as a cushion for unexpected events. So let's take a look at the financial statements and see what we see. So this is a simplified balance sheet. It's got three sections like I talked about before. If I can get over there. Yes. So here are that total assets, right? These are the current assets. These are the long-term assets. We subtract off depreciation each year and it accumulates. So that's the wear and tear. And then we also have startup expense that we put on the books. That's the things like pre-opening personnel, pre-opening marketing, and pre-opening admin expense. And all of that just stays on the books going forward. Doesn't change. It's the same year over year because it's what we had before we opened. Then we have the liabilities section. We have current liabilities, and then we have our long-term liabilities. Then we have our third section, which is member equity. Oh, total equity. It includes member equity. Those are the funds that people have given us in order to join the co-op. And the income or loss comes right off our income statement. And then the retained earnings is the accumulated prior year's income or loss. Now, the reason why we see this great number at opening for income is it includes, like, for example, the grants, the 1.5 million in grants that we were going to get. We put that in as income pre-opening. Then you can see that it jumps up to the accumulated or retained earnings. This is our income for the first year. And when you add those two together, that's our retained earnings for the second year. Okay, so then we move. Oh, I wanted to show you one more thing. remember that the balance sheet's a picture at the end of time. In this case, each year. So if we want to know what happened during the year, we have to look at what changed in the balance sheet. So this is the picture of member equity at the end of year one. That is to say that by the end of year one, enough people had joined the co-op, either before it opened or in the first year, that they had deposited with the co-op $237,600. By the end of the second year, that had grown to $280,800. But if we want to know how much people left behind in the second year, we look at the difference, which is $43,200. That is what happened during the second year. So now we're going to turn to the income statement. In a full-scale pro forma, the income statement might have as many as 100 rows in it. This one is very simplified and has only 16. Now, as I said earlier, we start with sales. We subtract off the cost of goods sold. And then we find out that we have a gross profit, in this case, $807,000, which sounds great. And as a percent of sales, we call it the gross margin. Now, personnel expense is our next biggest expense. And in this pro forma, I separated out a little separately here. And this is percentage of sales. And what's left, we call the margin minus labor. Now, I do this because gross profit and personnel are the two biggest levers that we have. What's left, margin minus labor, has to pay for everything else. And then as a percent of sales, this is what it is as a percent of sales. Now, remember I broke out rent and triple net separately in the operating assumptions tab. So that's here. We have other occupancy expenses. The depreciation, now this is based on the value of our assets and the useful life of our assets. So this is an automatic calculation. Then we have some operating expense, administrative expense. We have some governance and member expense, and then promotion or marketing expense. So all these are estimated. And then finally, we have interest expense, which is based on how much we borrowed and the interest rates. So we get a total net income. This is what happens when we subtract all of these expenses from this number here, right? We started out with sales, subtracted the cost of goods, subtracted personnel expense, that gives us this number, then subtracted all the rest of these expenses to arrive at a net income number for the co-op. Now that's bad, but remember, I'm more interested in cash flow than net income. So this is going to be, now I'm going to show you the simplified cash flow statement for this pro forma right here. And you can see this is net income in year one, right at the top, right? That's from the income statement. And there it is right there in the cash flow statement. And if you remember, the first thing you do is add back depreciation because although it's an expense, it didn't require cash. That's the example of the refrigerated case. I also add back interest expense because I want to do a cash flow calculation before any debt service. And I'm going to add this back in down below with debt service. So here it is here. Then there's some changes in our current assets. So for example, if the staff at the beginning of the year, we had $100,000 in inventory. And at the end of the year, we had $105,600. Our inventory has grown by $5,600. Now, the only way it can grow is if we bought it from our vendors, right? So it took cash to do that. But that's not an expense because we still have the inventory. It's sitting on the shelf. It's just a change in the asset. So we record that change here in the operating section. And the same thing with current liabilities. So if we happen to increase the amount of accounts payable, we've increased the amount that we owe our vendors for the products that we've bought. Well, when we do that, then we've actually, because we've borrowed a little bit more from our vendors, then our cash is a little bit higher than it would have been otherwise. So all that combined together is cash flow due to operations. So in year one, I'm getting my cursor over there. In year one, cash flow due to operations is a minus 131,000. You can see by year four, it's positive. The next is cash flow due to investments in our assets. Now, I've combined the leasehold improvements and the equipment into a single line. And I've said that this co-op will invest $12,000 in the first year. Now, it's more likely that they will be very low in the first year and very high in a later year, but I'm just sort of spreading it out over each year based on sales. Now, this is to keep the co-op looking fresh and new so that it can continue to be competitive in the marketplace. So there's estimated investment in the facilities. Then we have cash flow due to equity activity. Well, this is the money that people left behind when they came in the first year and got excited and joined the co-op. If you remember my example, the second year, the difference between member equity at the end of the first year and the end of the second year was 43,200, and there's that number, right? That's the difference for the year. So when we add up the three sections above, which is operations, investment, and equity, we get cash flow before debt service, right? That's so we can just see, how are we doing before we get to debt? Then we look at our debt service. So now I'm putting the interest expense back in right here. That was, remember, that's the reverse of this number here. It's an actual operating expense, but I move it down into the cash, into this debt service section. This is the change in the principal that we owe. So we paid $40,382 in principal over the year. It went down, the amount of principal that we owe, and that indicates that our cash went down as well. The total of our debt service is $112,882. So when we add this to the number above, the cash flow before debt service, we find out what our total cash flow is. So for in year one, it was minus $199,000. Not looking great. Now we started the year with $383,000. So we can add those two numbers together and find that we should end the year with $183,973. Okay, so this is the moment we've been waiting for. How's this co-op going to do over time? I'm going to spread this out a little bit, and I'm just going to scroll over, and that is a lot of red ink, right? So you can see that right now, this co-op isn't sustainable. At the end of the third year, it's going to be out of cash, right? It begins the year, that's column E, with a little bit of cash, but not too long before it runs out completely. It'll be bankrupt. So if you use this in your narrative and you talk to funders, it's very likely they're going to look at that and say, I don't think I want to participate. In the workshop portion coming up, when we talk about vision and sustainability together, we're going to look at some of these various inputs to see if the vision can change enough to get us to a sustainable co-op. So here we are at the end of this session. We've talked about vision. We've also talked about the three financial statements because I wanted you to begin to get an idea of the connections. We talked about how vision through the pro forma leads to assumptions, which then lead to the results, which may then have to lead to adaptations in the vision. In the workshopping session, we'll look at how adjustments to the vision impacts our assumptions, which in turn will impact results. We'll look specifically at them. We'll see if we can find a way to where the co-op looks to be financially sustainable and we're comfortable it'll be in keeping with the core vision. Thanks for joining me for this session. I hope it's been time well spent and I was able to help increase your understanding of both vision and its impacts. Reach out anytime. My email address is simply my first name, last name at colluminate.coop. Colluminate as in lighting the way forward together. And my last name has 2 T's. Just let me know how I can help.